let me just kind of give you guys a little bit of a background just on who I am and what I do and kind of who's talking to you today. Where's this information coming from? So I'm one of the partners of Marshall Reddick Real Estate. It's a nationwide residential real estate firm that specializes in investment real estate and also offers a one-stop shop for property management and insurance and many other topics many other services that are needed for real estate investors who are looking at building a portfolio. So we are realtors, property managers, and I noticed you mentioned about mortgage note investing. We're actually a private money lender as well. We operate in 8 different states across the U.S. So I'm going to be speaking to you guys from an educational standpoint today to provide you with a lot of very helpful and actionable tools to help you plan out your real estate investing strategy, but also analyzing the financials, evaluating different markets, and looking at things from kind of every angle needed in real estate investing. So, and real quick, I'll run through this quickly. I started in real estate 15 years ago, working for the same company I'm a partner of today, Marshall Reddick. I did get a bachelor's degree in business administration. Had no idea what I wanted to do at the time in college. Was lucky enough to be guided towards the real estate industry, where I have not looked back since. I do have a real estate license I got 11 years ago. That's not my day job. My day job is overseeing our real estate and property management divisions. I did buy my very first investment property about 12 years ago. I still own it. It's very far from where I live. I'm talking to you guys from Southern California. And I bought my very first property all the way in Alabama. And then several more since then. All my rental properties thus far have been out of state, outside of California. So I do own a couple properties in Phoenix, Arizona as well, and then in the San Antonio, Texas market. So I'm going to be teaching you. I know we have people in California, Arizona, I think Oregon as well. We all have the tools and capabilities today to be purchasing properties far away. Some of our clients live internationally in China, in Costa Rica, in India, in many different places, and they're buying properties in the United States, and they're using the same tools and the same strategies that I'm going to be teaching you guys today. So I'm going to be jumping between some slides and then also our website, because that's where a lot of the educational tools are offered. So like everything, in life, any large investment, any business venture, any major commitment requires a lot of education. So it all kind of starts with education. My belief is that real estate education should be free. Very strong belief that it's not necessary nor needed to be paying lots and lots of money for real estate investing education. That's certainly offered through a lot of large companies that do charge tens of thousands of dollars for real estate investing information. This is stuff that you guys can find out on your own online. There's no necessarily like a secret sauce. This is information that has been used by thousands, tens of thousands, hundreds of thousands of people over many decades. So we've compiled a lot of free education that I'm going to be sharing with you guys today. Now, one in particular is a financial calculator. Now, think of a financial calculator. If you're a soldier, in the military, if you're in the armed forces, and you are essentially going out for combat, you need to have your armor, you need to have your shield, you need to have your weapons, right? Now, as a real estate investor, I believe that one of the most necessary tools, similar to a soldier in battle, is having a robust and a proper financial calculator. So I'm going to kind of start off sharing with you guys a very intuitive calculator available online, and I'm going to be using it in some examples today. So let me switch over to our website here. Okay, so this is a web-based calculator. It is available on mobile phone, on tablet, on desktop computer as well. And it can be accessed through the URL link at the top of my page here. So our website, marshreddick.com, has tons of free calculators and tools that I'm going to be sharing with you. So one of them is our financial calculator. Now, this is not your average Excel spreadsheet. It's not, you know, I like to call it, it's not your grandma's financial calculator. This is a very, very intuitive and very comprehensive financial calculator. What I've noticed over the years is that people tend to have kind of their own spreadsheet, you know, that they've taken countless hours putting together. 99% of the time it's missing something. The correct formulas are not in there. The necessary expenses are not in there. And so I do encourage everybody to use this calculator for many reasons. One, you can analyze properties with financing. You can also evaluate properties on a cash purchase. If you're using hard money or private financing, you can also switch to a calculator that incorporates that type of financing as well. But if we're just looking at a property in particular, you know, many of us will be looking at real estate on various websites like Zillow or Redfin or Realtor.com. You know, the only problem with that is that all we're really able to see on those websites is the price and the property taxes, the homeowners association fees, if there are any. But that's about it. You know, we're not really able to get any deeper than that. They're not going to provide a rental quote number. You know, they're not going to provide calculations for cash flow or cash on cash return. So, you know, if we're looking at a particular property online, and switch to a property that I had found here. Sorry, let me just hide my controls. Okay. Sorry, there it is. Okay. So I'm looking at this property now. This is the property in the San Antonio, Texas market. It's one of the markets that is constantly named as the fastest growing city in the country. You know, it's been in Forbes articles and Business Week articles and CNN articles on one of the best places in the country to invest. So I pulled this property because it sort of fits with the pricing and the rent amount that most investors would find attractive from a cash flow basis. It also happens to be, you know, located near good schools, and it's a new construction property. So like I mentioned, you know, on Zillow, we're only really able to get as deep as the purchase price, and then we can find information on property taxes. In many cases, we're going to have to, you know, do our own due diligence on rents and insurance. So what you can do is take the information here and plug it into a financial calculator, and you can change the numbers for down payments. Let's say we want to do a 25% down payment. And on most properties that we purchase, there's going to be some initial repairs needed. Now that might be new carpet or paint or just some minor maintenance work. So we can factor that in to the analysis to find out what our total purchase price cost is. Now, what I like about our calculator is that it autofills an estimate for closing costs. And if we look at that, it'll give us a very somewhat complicated looking formula for how closing costs are measured. Now, closing costs are going to include things like a home inspection, an appraisal, lender fees like processing and underwriting fees. And we won't always know exactly what that number is because everybody's credit down payments are a little bit different. But our website has a formula for a very conservative estimate on what those closing costs would be. Now, we can see the loan amount. Let's say our lender has quoted us an interest rate of 5%. What's great here is that, you know, most of the time we're going to be looking at a 30-year fixed interest rate loan, but you can even adjust that to a 15-year loan to see what the mortgage payments are going to look like. As I kind of go down here a little bit further, there's even a place that we can add additional principal payments. If we want to pay the loan off sooner, let's say we make an additional $500 a month payment towards principal, it'll tell us, if we click this little pie chart here, what the entire amortization schedule looks like. Now, instead of a 360-month payoff, if we put $500 a month towards our mortgage payment, we'll pay the loan off in 155 months. And if I revert that back to 0, then again, there it says, of course, the 30 years. So it's really a neat tool to have here to see how much we can save in interest by applying a little bit extra towards our principal payments. So let's just say we're going to keep it at a 30-year loan. I'll click that pie chart again. So we can plug in our numbers for property taxes. I'm just going to put an arbitrary number here. And we can plug in our numbers for insurance as well too. I'm sorry, what I needed to do here is switch to annual. So if you click on this monthly button, it can change right to annual. Property taxes are usually provided on an annual basis or semi-annual, but we're going to add that up to $2,000, and we're going to say that we got $1,000 annual insurance premium. I can switch that back to monthly and see what the numbers look like on a monthly basis. We can add in our property management fee. I highly recommend using a professional property manager. Usually a property manager charges between about 7 to 10% a month of the monthly rent amount. We charge 7%, so I'm going to plug that number in here. We can plug in our numbers for HOA, utilities, and landscaping as well too. Now, in most properties, especially single-family detached homes, tenants are going to be responsible for paying utilities and landscaping. When you have multi-unit properties, you gotta pay attention to that, because sometimes water can be individually metered in multifamily unit properties, especially older ones. So in doing the due diligence, you'll find out whether all the utilities are separately metered or whether there are any that are on one meter. So this is single-family homes, so I'm going to leave that blank because tenants will be paying for their gardening and utilities. So now we get down to the variable expenses. So we call these our fixed expenses. This would be principal, interest, taxes, insurance, property management fees, HOA fees. These would be considered our operating expenses, and then mortgage would be considered our debt service. So these are going to be our fixed expenses. We have to pay them. We're going to be paying them regularly, but we're going to have some variable expenses too. And that's what I'm going to spend a little bit of time on here after the calculator, is to teach you how to calculate vacancy and maintenance, because it's not a matter of if we're going to have vacancy and maintenance, it's a matter of when. And a lot of investors have a very difficult time factoring in exactly how much vacancy and maintenance they can expect to have. Now, it's going to be based entirely on the property class of a property. So I'm going to put in here 10% vacancy, 10% maintenance. So this particular property is considered a B-class property. I'm going to explain to you what exactly that means here in a moment and how to calculate property class. But based on our teachings, a B-class property, you would want to factor in an estimate of 10% a month vacancy and 10% a month maintenance. So we're going to plug that in. We're also going to have to put in our rent amount. This particular property actually rented for $13.95. And then we can see what the cash flow looks like. So tells us our gross rent, fixed expenses. Again, that's principal, interest, taxes, insurance, HOA fees, if there are any, and property management fees. So this particular property, after fixed expenses, has $246 a month of positive cash flow. How we get to that number, every field on our calculator has a function symbol, which you can click on and it'll tell you the calculation. This one's pretty simple. Rent minus total fixed expenses. And then we factor in variable expenses. So now it looks like, and this is more of a, I guess I could say on paper, it looks like a negative cash flow property. However, you're not going to have these variable expenses on a monthly basis. So there will be months on this property where we are netting $246 a month of cash flow. Occasionally over time, there will be maintenance and vacancy. So we can also see what the long-term return on investment looks like. And we can do a example for how many years we plan to hold the property. Now I'm just going to plug in 3% a year of annual appreciation. I'm going to show you where that number is going to come from in a second. Excuse me. But we can see our long-term projections here. If this property goes up in value 3% over a 15-year period, with straight line appreciation, we're looking at a $108,000 gain. It's going to give us, it has a mortgage calculator built in here. So we can find out how much the balance of the loan is reduced over a 15-year period based on our down payment and based on the interest rate that were quoted by our lender. Selling expenses. So you can see I've hovered over the selling expenses tooltip, and it says 3% for the listing agent fee, 3% for the buyer's agent commission, and an additional 3% for closing costs. Now, this is also an estimate. We factor a very conservative number of 9% of the future value of your property. So when you sell a property, a seller is responsible for paying both agent commissions, and the seller will also have some of their closing costs for title and title insurance and escrow as well too. So where we're getting this number 27,000 is basically the summation of the appreciation over time and the current purchase price today, that number multiplied by 9%. So that's already built in here. Conservative estimate, 9%, I would say, is probably on the higher end. One thing that is very useful, and it's something I don't see on any other financial calculator, is total projected profit. This is based on a lot of different calculations, but one in particular that is the true formula for projected profit is what we call CAPE, C-A-P-E. That's cash flow, accumulated cash flow plus appreciation plus principal pay down, because that's equity that we're building, minus selling expenses, or excuse me, it says plus selling expenses, but selling expenses here is, of course, negative. So if we add up these four numbers here, that's why we're getting $121,000. We just need to make sure, obviously, the numbers we're using are accurate. We can see what our annual cash-on-cash return looks like with no maintenance and vacancy, and then what that cash flow would look like if the rent does not increase over time, because we have not factored in any rent increases. So let me take you back here to my example that I wanted to use here. So I went to this page by going to our Learn section. I clicked on Education, and then on the left-hand side here, I clicked Calculators. Now, there's another calculator that I want to share with you right now. It's nationwide appreciation rates over the last 25 years. Now, this data comes from the National Association of Realtors. On our website, oops, sorry, one sec. Jump right back to that. On our website, you'll find a free ebook. It's about 40 pages, and you can find it on the Marshall Reddick website by clicking on Invest and then clicking Properties, and then clicking this button here on the right that says How to Choose the Best Investments. When you click on that, it'll download for free, and it's what we call the Reddick Property Rating ebook, How to Choose the Best Investments. It's about a 40-page ebook that is full of information and education on how to evaluate a property based on property class. One of the pages inside of the ebook is this map right here. Now, this map is from the National Association of Realtors website, realtor.org. And for the last 25 years, the National Association of Realtors has been tracking median home prices month over month, year over year, in every major metropolitan market in the country. Now, when you click on the digital ebook, when you click on this map, it's actually hyperlinked, and it'll take you directly to the National Association of Realtors website. And it looks like this. So the website you'd be taken to is exactly what I have in front of my screen right here. Now, you can click on any marker. Every marker represents a metropolitan market in the United States. There's about just under 300 major metropolitan markets. Now, you can click on any one in particular. Use San Antonio as an example, and it'll give you the current quarterly median home price. Now, that number is very important because that is going to be the basis for what determines property class in any given market. So what we've done is we've taken this data from the National Association of Realtors, and with our web development team, we've encoded it directly on our website on this, this calculator that I'm looking at right here, again, on our Learn page, by clicking Education and going to Calculators, and then clicking Market Appreciation. So the data is exported from the National Association of Realtors website, but what I can do is select the market. I'm going to go down to San Antonio, Texas. And our web development team turned the data into a very useful and interactive graph here. So the table of year-over-year median home prices in San Antonio is in front of your screen right here. So from 1989 to 2018. Again, this data is available for every major metropolitan market in the country. Now, the best way, of course, to predict the future is to look at the past. But we know real estate cycles can be very different from one another. Of course, the last real estate cycle over the last 10 to 12 years looks quite different than the cycle before that. So it's important to look at multiple cycles of real estate when looking at what the potential for growth in a market will look like in the future. So we have the year-over-year appreciation table here, and then the graph is right above it. And we are again looking at the San Antonio, Texas market, but you can choose any of the markets that are available on the screen there. You put your cursor over it, it'll tell you the median home price in that particular year. And of course, we've even put a projection here based on the 25-year average. Now, what I have below that is the property rating scale. So this data comes directly from the ebook on our website. And I'm going to share with you a page of the ebook right here. This is the property rating scale. Now, you can find this in the ebook, but I screenshotted it, and I wanted to spend a minute going over this with you. Excuse me. So every major metropolitan market in the country has a to Z for property classes. Now, property classes range from luxury class down to D class. And again, the basis for what determines property class is the median home price. So if we're looking at a single family detached home, then we're looking at the graph on the top, the scale at the top of the screen. So what this says is that we would plug the median home price for whatever respective metropolitan market we're looking at, right where it says 100% on the top. So 100% relates to the median home price in any given metropolitan market. Again, you have that data available to you now, and so you would plug the median home price where it says 100%. So going back to San Antonio, the median home price over the last year was about $230,000. So what that says is as an example for San Antonio, if we're looking at a property in San Antonio and the value of that property is $250,000, well, we would divide $250,000 by 230. Of course, it would be 1.1 or 1.2%, and that would fall into the A class scale. And if we're looking at a property in San Antonio, if it's a single family home, and let's say the value or the sales price is less than $115,000, that would be considered a D class property. Now, I know that we're in many different geographic locations of the attendees here today. So each market is very, very different. I'm in Orange County. Median home prices in Orange County, California are about $800,000. So if I'm looking at a property in Orange County, I got to use this property rating scale because it's going to be quite different from market to market, right? A $850,000 property here in Orange County is an A-class property, whereas in San Antonio, an $850,000 property is way beyond the luxury class category. And similarly, a $200,000 property in San Antonio would be considered a B-class property, whereas a $200,000 property in Orange County doesn't even exist. So it would be far off the right-hand side of that screen there. And then if we're looking at a multi-unit property, a duplex, triplex, fourplex, then we want to use the scale at the bottom. And it's adjusted because there are shared common walls. The data that we have for the median home prices is based on a single-family detached home. So if we're looking at a 2-unit, 4-unit, we adjust on a per-unit basis because they have shared walls. They're not going to have a backyard and no common walls like a single-family, thus the adjustments that you see below. So this is the reason why I'm talking about this. This is the reason why it's important to understand property classes, because different property classes are going to have different amounts of maintenance and vacancy on a long-term basis. So what you're looking at on your screen there, we'll use the table at the top. 1 to 4 units, which would be considered a residential property. Building that has 5 or more units on the same parcel is considered commercial. So I'm just going to talk about residential on a 1 to 4 unit property. So let's look at B class. So B class says that we want to use 10% a month maintenance and 10% a month vacancy. Those percentages are percentages of the monthly rent amount. So that property that I was looking at just a minute ago in San Antonio rented for $1,400 a month. So the numbers that we would want to plug in are $140 a month of maintenance and $140 a month of vacancy. Now, once again, you're not going to have maintenance every single month on a property, hopefully, otherwise it's a really bad property. This particular property we're looking at is new construction, so unlikely we're going to have maintenance for quite some time. But real estate is a long-term investment, and the average investor holds their property for about 10 to 15 years. And we're going to have tenants move out. We may have a tenant that moves in on after we buy it, stays for 2 years. They move out. Let's say there's a 30-day turnover, and then we get another tenant who stays for 1 year. They move out. Let's say it's a 40-day vacancy in between. Next tenant comes along, stays for 3 years, right? So if we're looking at a 10 to 15-year basis, excuse me, we may have 5, 6, 7, 8, 9, 10 different tenants in that property. Now, this is long-term tenancy, meaning the leases are for 12 months minimum. So how do we get these numbers, and where is this information coming from? Once again, it's coming from the data in our property rating ebook. Now, because we're a property manager, we looked at hundreds and hundreds of tenant applications on properties that we manage in markets all over the country. And we spent several years writing this book, published it 2015, and the information is just as relevant today as it was when we published it. It's not time-sensitive information. Of course, the prices change and median home prices change, but the tool, the scale, the calculations and formulas do not. So what we came up with was this infograph that you see on your screen here. And over the hundreds of properties that we manage in markets all over the country, we noticed a very common trend in some of the demographics of tenants in our properties that we manage. And at the top, basically what we noticed is that tenants in higher property classes tend to have white-collar jobs. They're usually professionals that might specialize in a particular field. They tend to have a little bit longer job stability. So what we noticed is tenants in higher property classes tended to move less often in our properties because they did not change employment as often as tenants in lower property classes. Also, what we noticed is that tenants in higher property classes, and usually A-class properties, sometimes luxury class properties as well, we noticed that there's a much higher percentage of renters who had previously owned a property or planned on owning a property at some point in the future. And what we've noticed in just the management of these tenants is that they tend to take better care of properties. They knew not what to flush down the drain. They used hair catchers in the shower drain. They replaced air conditioning filters. They reported maintenance more often. Maybe they were more conscientious, or maybe even they had more experience of maintaining a property than tenants that we call lifetime renters, who had never owned property before and had no plans on owning in the future. So these factors tend to translate into less maintenance and less vacancy over time in higher property classes. And what determines the property class of a property is not so much the age of the property, not so much the condition of the property, not so much the size or square footage of the property, but much more related to where that property is located within a metropolitan market? Is it located near the higher rated schools? Is it located near the lower crime rates, right? Or is it located in high crime areas, low rated school districts, and less desirable areas of that metropolitan market? Again, every metropolitan has luxury A, B, C, and D class properties. They may just be in two completely different parts of that metropolitan. And the home price data that we get from the appreciation data we get from National Association of Realtors is based on the metropolitan. It's not specific to zip codes. It's not specific to certain towns. It's specific to the entire metropolitan market. So, sorry, give me one sec here. So coming back to the expenses for maintenance and vacancy. So these are the numbers that we want to be using. And oftentimes people, they go online, they Google, vacancy in Austin, Texas, right? And they're given some arbitrary number that we can't really figure out where that data is coming from. Is it based on certain zip codes? Is it based on different property types, right? Apartments might have different levels of vacancy than single family homes. So I do not recommend using any data online that says a vacancy rate for a specific town. That is not going to be the true vacancy of your property. What's going to determine the vacancy, once again, is the property class. So how does vacancy rates translate into amount of days that we're going to have a particular vacancy? So if you multiply the number of days in a year by any one of these percentages, that basically tells you how many days each year you're factoring for vacancy, right? Once again, our property is not going to be rented forever. There are going to be periods of vacancy. So if we're using 8%, then we're saying that in our projections, in our calculations, we are taking away 30 days, 1 month out of the year of income to factor in what our true income will be. That's the difference between scheduled income and effective income. Scheduled income is the monthly rent times 12. Effective income is how much rent we actually receive. So, the question on everybody's minds, and probably the most common question I get is, well, where does it make sense to invest, right? Does it make sense to buy a property where I live in my own backyard, or should I be looking elsewhere, right? Certainly, if looking at a primary residence to live in, we're going to use a lot of personal bias. We're going to use a lot of emotional factors, right? We might want a big backyard because we have 2 kids and 2 dogs, right? Maybe a big backyard is important for us. Or we might want to be in a particular commute within our job or employment. Maybe we want an entertainer's backyard. Maybe we want a large a chef's kitchen. Maybe we want large closet space for our shoes and clothing, right? Now that's not an investment, right? That's an emotional decision that is personal to our livelihood. However, when we look at it buying investment properties, all that needs to go out the window, and we have to look at the data, the facts, the statistics, the research, figure out, well, where is the demand, right? Where is the demand for renters? Where is the demand for employment? Where is the demand for purchasing properties? Which markets are poised to see the most growth in the future? So these are some of the factors that we need to be looking at. And one in particular that I want to highlight is number 3, economic diversity. Now that is probably one of the most important factors when purchasing a property, and the locations that offer the most economic diversity are major metropolitan markets. So a few in particular that I have on my screen were San Antonio, Texas, Austin, Texas, Phoenix, Arizona. These are major metropolitan markets that have a large diversity of employment. There's going to be jobs in government. There's going to be jobs in education, healthcare, trade, manufacturing, technology. We're going to see jobs in a lot of different industries. Now, that is very important when buying investment properties, because that is going to open up a large segment, a large rental market, a large pool of renters. It's also going to attract more people moving and purchasing properties as well. So that all adds to the growth and the long-term outlook of a metropolitan market. Of course, we need to have reliable property management. So our strategy that we always teach and that we recommend is to buy property in major metropolitan market because you're going to have a larger tenant base. Now, if you're looking at properties 2 hours outside of the nearest job market, some of us will get swayed by the lower prices, right? If we're looking at properties, I'll use California as an example. Let's say way out in the high desert, Antelope Valley, Palmdale, Lancaster, if you're familiar with Southern California. Now, these markets these are what we would call smaller, non-metropolitan markets. Now, it's about 2 hours or more away from the nearest downtown major center of employment. But when we look at properties that far away, they're going to be a lot lower priced. So some of us are going to say, wow, the prices look very attractive. However, we're not going to benefit from the job growth. We're not going to see the appreciation in value over time. We're going to have a smaller pool of renters. We can expect to have longer periods of vacancy. We probably won't be able to get the rent increases that we would get if we owned a property in a major metropolitan market. We're also not going to have very much selection of property management. In a small town, there may only be a couple property managers. So it's important that we look at a major metropolitan market. Now, the other part to that strategy is to stay away from the downtown and look at the suburbs of major metropolitan markets. Again, this is a long-term investment. We want to attract good quality renters. And I'm going to be a little biased here on the type of renters that we're looking for, but you can see at the top of our screen, we recommend buying properties that will attract families. And what type of properties will attract families? Well, certainly a one-bedroom condo, a two-bedroom condo, probably not going to do it, right? Families tend to look at 3 to 4 bedroom, 2 to 3 bath, 2-car garage, single-family detached homes, and that is the recipe for success when buying investment properties. Not a 5-bedroom home, because those are not going to command the rental demand that a 3 or 4 bedroom would, and not a 2-bedroom home for the same reason. Similar to that, we don't want to be buying a property that is 3 or 4 bedrooms but has 1 bath. So again, 3 to 4 bedroom, 2 to 3 bath, 2-car, single-family detached home is the recipe for success. It's the most demand from a rental standpoint. It's the most demand from a resale standpoint, and it's going to attract long-term renters, right? So I don't recommend a lot of the niche strategies. I don't recommend renting a property to college students. I don't recommend properties that are like short-term Airbnb vacation homes. It's something completely different. A lot more costs and expenses come along with that. We want the least amount of vacancy possible. So those types of properties in major metropolitan markets are going to attract long-term renters. Now, the ideal is a family that is looking for a property within the school district that they want to enroll their children in, because those renters, again, tend to stay much longer. And when we're in the suburbs, we tend to have better school districts, lower crime rates. We usually find newer properties in the suburbs that can tend to be within the path of growth for longer term appreciation over time. So this is a list of 16 major metropolitan markets that our company operates in. It has boots on the ground, real estate agents, property managers, leasing agents, maintenance, contractors, the entire team needed in each one of these markets. Now, I'll just tell you that in California, now it's obviously a difficult market to find positive cash flow. We do sell some investment properties. It's not a very high percentage of our total sales. Where we do see the largest amount of demand are in the states of Texas, Tennessee, and Florida. Those 3 states do not have any state income tax, Texas, Tennessee, and Florida. They're also considered the 3 most business-friendly states in the country. And there is also very high home affordability in these areas. So when we look at the median home prices in most of these cities in Florida, Texas, Tennessee, median home prices range from about $150,000 to $250,000. Now, if you know the nationwide home price average, you can find it on the National Association of Realtors website. It's just under 300,000. About 290,000 is the United States median home price. Some of us might be looking around our backyard going, wow, you know. So ideally, we want to be below that. And when we're in that price range of about 150 to 250,000, if we're in one of these locations, highly likely that we're going to see positive cash flow. In that range of 150,000 to 250,000, we tend to see a higher rent to price ratio. And rent to price ratio is just calculated by taking the monthly rent and dividing it into the purchase price. The property that we were looking at earlier in Texas, that property sold for $194,000. The rent was $1,400 a month, so we would take $1,400 divided into $149,000. If we can get to about 0.8% up to 1%, that's the range that we're going to see positive cash flow. And the very reason that there's no opportunity for positive cash flow here in California is because an $800,000 property is lucky to rent for $4,000 a month. There's no way that $800,000 property is going to rent for even close to $8,000 a month. So you start seeing diminishing returns when you go up higher and higher in purchase price. So that's why 150,000 to 250,000 is a really good range to look at within these metropolitan markets. And these markets, aside from California, offer those prices. So going back to the calculator here. Any given market, you can actually click this button at the bottom that says print to PDF. You get a nice PDF view that has the graph, the table, and the property rating. One other thing I wanted to share with you is the marketplace for real estate investments on our website. So if you click on invest and then click properties, you'll be taken to our marketplace for investment property. Now, this says there's 4,688 results. You can edit the number of results you see on each page. Now, there is an account feature on our website. Now, if you star properties, you have your own favorites section here. You can filter by the properties that you've favorited. You can also personalize the display of data that you're looking at by clicking personalize display. And you can select or deselect any of these filters that you see on our website. One of the coolest features on our website, though, are the filters that we have to narrow down properties that you're looking at. Now, there's a lot of different filters on our website. We've modeled it sort of based off of Zillow or Redfin or Realtor.com. But again, those websites are used entirely for purchasing a home. There's nothing investment related on those websites. But if you jump on our website, and you can even plug your own property into that calculator, you can use all these different filters here. So you can filter properties that were built after 2010. Let's just say in a few different market examples. So nothing found with that filter. Let's see. Doesn't sound right. Okay. I think I need to clear my search. Sorry. There's something. So yeah, you can use all these different filters on our website based it on list price. Say you want to stay, under 250,000. Click done. You can also sort properties on our website. So if you want to see properties that are newest or oldest, you can click on year build as an example. So you want to you can sort based on bedroom, list price, a lot of different sorting options here. So kind of going through that a little bit. You can create your own account on our website, and you can manage your account. Has some of our information in here if you want to look at properties you favorited. We also have a mortgage section on our website. You can look at different mortgages that you favorited in the past. Events, we do a lot of free webinars as well. So it keeps track of any webinars and webinar history that you've attended in the past. I'd like to just kind of take a minute just to kind of come back to our Learn page here. When you come to the Learn page, there are, as you can see on the left here, several hundred videos, articles, guides, calculators, and tutorials, all available for free on our website. There's no paid payment option. There's no subscription. This is all free information. You can filter based on topics as well. So if you click topics, there's about 50 different topics here to choose from. For example, we can click on 1031 exchange. And we're provided with several videos, articles, guides, specifically on how 1031 exchanges work. You can look at IRA, self-directed IRA investing, so a lot of good topics to choose from. So I wanted to give a few minutes, I think, for Q&A. I just kind of wanted to additionally mention that for property management, there is a section on our website that you can find out property management fees in all the different markets we're in. There's a client portal login for landlords to be able to log directly into their owner account. And we even have our rental listings available on our website too.
This is great. Thank you so much. So say I was on the website and I found a property. What's the next step?
So if you see a property that you like on our website, you can click on more information. Let me get back to that. So you're interested in a particular property, you want more information about it. I'll just use this one as an example. If you click on the property, it'll open up in a detailed view. So you can see pictures, and I didn't even get a chance to go over this much, but a map view. You can switch between photos and a Google Map view so that you can see directly on there where the property is located, and you can also do street view. So you can click on I want more information. That'll send an email to one of our advisors who will reach out to you and just really schedule a call to talk through it. Every property on our website has the rent amounts, school district ratings, the appreciation, and then that detailed financial calculator is already filled out. So to answer your question, if you see a property you like, you can click on I want more information. One of our advisors will contact you. And it's a very, very consultative type of approach. We don't sell mentoring. We don't sell education. We work at everybody's pace. So some people haven't yet really spoken to a lender, don't know exactly how much financing they can qualify for. So we'll take people through that process, connect them to a couple lenders, connect them to a couple of insurance agents. From time to time, we get people who want to fly as well, and we can accommodate a trip.
What happens after post-purchase? How does that work? They decided that it bought it, and now what?
Yeah, so before escrow closes, our real estate team will connect you with our property management team. And the property management team will be provided with the home inspection. If there was a request for repairs negotiated during escrow, that'll get sent over to our property management team so that once it closes, our property manager does a walkthrough, sends any bids for make-ready repairs to the owner. As soon as that's approved, we'll do the touch-ups, the repairs needed, and then immediately we'll take professional photos and then list the property for rent on all the major platforms. So we advertise on Zillow, Trulia, HotPads, Realtor.com, and then you will be connected with our leasing agent who will give you weekly updates on the number of calls, the number of showings, and any applications that are received. We average about 30 days or less in terms of initial vacancy.
So it's conceivable to not even have to leave your house to get all
100%.
Oh, that's
this
awesome.
is designed entirely for people who do not need to be hands-on or visit their particular property. And again, we have clients all over the world that we communicate with on different platforms like WeChat or Skype. And so I would say that, the first-time investor, many of them they want that comfortability. They do want to travel to that particular location. We can certainly accommodate that, but the large majority of our clients, and I mean like probably 95%, are not even physically going there. They're able to get all this information directly online, over the phone, over email. And it's a step-by-step process. It's certainly not an overnight thing. There's many conversations that take place.
Do you continuously evaluate new metros or new rental areas? Because I'm assuming once this list is standard, I'm sure everybody around the world is trying to invest in the same areas, right? Do we have a saturation at some point of just rental properties?
Well, so we've intentionally located ourselves in major metropolitan markets. This list has not changed very much over the last 10 years, and it's unlikely to change much over the next 10 years, unless something changes to the political environment of that state, unless there's major changes to the, really, I mean, it comes down to kind of the politics of that particular area. But there's only been maybe one or two markets that we've pulled out of or added on our website over the last several years. And, these locations that we're looking at, they offer a very complex variety of benefits for real estate investors, are really in those business-friendly states and large metropolitan markets. We do constantly evaluate locations. We look at Portland, Oregon. We look at Salt Lake City. We look at Denver, Colorado. We look at Seattle, Washington. All great places to live. I love each one of those locations. They don't tend to provide the prices, the returns, the cash flow, or the rental demand that we do see in these metropolitan markets. A lot of these locations that you see are state capitals, like Phoenix, Boise, Austin. A lot of state capitals that are really just poised for many years of long-term growth. So, it doesn't change too much. The real estate market, what we saw, and I think a good indication of that were those 25-year graphs that I was looking at. And I'll just kind of use an example again. Not every market looked like San Antonio. In fact, San Antonio, Austin, Dallas, particularly these cities, are very unique in terms of the prices of what happened in 2008, 2009. Now, we can look at a different market like Phoenix. And Phoenix looks like that.
Wow.
It's completely different, right?
Right.
And then a lot of other markets look like that too. We can look at Indianapolis. I mean, there was somewhat of a drop. Vegas, we know Vegas, was heavily affected by the recession. But there are some locations that would be considered recession-proof.
I guess, like you said, it's a long-term investment, right? So you need to expect those ups and downs.
Yeah, we know, and there are markets, and many of which that we're in, like Clarksville, Nashville, Texas, that did not really see any downturn, right? And this is the Clarksville, Tennessee market. This is one of the locations we're in, which is just outside of Nashville. If you look at the last 25 years, the biggest downturn they saw was a negative 2% in 2011, right? Now, that is not going to be indicative of most of the United States, right? We look at, let's say, San Diego, California. We saw a negative 34% decrease in 2008. So we're constantly looking for these markets that are what we would consider to be recession-proof. Why are they recession-proof? Based on a lot of the factors that I covered for affordability, economic diversity. This is Austin, Texas.
I may have missed this earlier. If I decide to sell the rental property after a few years, do you handle the sales of that as well as part of the service?
Absolutely, 100%. Okay. We are even currently right now doing a lot of 1031 exchanges. 1031 exchange is a way to sell an investment property and defer the capital gains tax and not have to pay that tax when you sell. When you own what's called a non-owner occupied property, the IRS says that you're subject to capital gains tax when you sell it. 1031 exchange is this little loophole where if you perform a 1031 exchange and you work with a qualified intermediary and you sell a property and identify replacement properties within a 45-day period, then you can just defer that gain and defer the equity into other properties. So we're seeing this with a lot of people who are selling a property that they may have owned for many years. It doesn't have very much cash flow in it, but it does have equity, and they're selling that property and they're buying 2, 3, 4 properties with that gain, and they're doubling, tripling, quadrupling the income because they're buying in markets that provide more positive cash flow.
Okay.
To answer your question,
Scott?
yes, we do. We do. Yes.
We're at the top of the hour now, and I wanted to thank you for coming in and presenting to all of us.
You're very welcome. Thank you, Daniel. Thank you, everybody. I really appreciate you guys taking time here. I do have my contact information if you'd like to send me an email or phone call. Really, just from there, happy to connect with you guys over the phone more and help you evaluate your investment strategies. So thank you so much for this opportunity, and happy Friday. I really appreciate it.